Sometimes a rising tide only lifts one boat. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. I'm not surprised by NVIDIA. I am surprised with the rest of the market.
Yeah, interesting day here. And I guess NVIDIA wasn't the savior some people had thought.
So let's get checked out here. We get the S&P down by about 0.9%. We're right around the lows of the session. The next index is the Magnificent 7. It's up by 0.2, but only because of what we're seeing with NVIDIA. That's still strength to strength, still right around its recent records, past that $1,000. Also, Tesla, though, not helping either. That stock, one of the worst performing stocks within the S&P. Also not helping, Live Nation, the worst performing stock on the S&P. The DOJ and other states filed a suit to break up the company. More on that in the next couple hours. Two-year yield shooting higher, up 6 basis points. That is eco data, Romaine, continuing to come in strong.
Yeah, and we really talk about how NVIDIA was really supposed to be that big catalyst, that big market catalyst for further broad market gains. But almost 24 hours later, we see that broadly positive earnings report has primarily been a catalyst just for NVIDIA and maybe a few of its AI brethren. That included at least one point on the day server makers like Supermicro and Dell Technologies still holding on to gains, at least for Dell. Supermicro now coming off of those highs. And you had chip makers like Broadcom, Marvell, as well as AMD that had also rallied earlier in the day and now seeing softness. At one point, the Philadelphia Semiconductor Index and the NASDAQ were at fresh record highs. But of course, if it wasn't for that 11% jump that we saw NVIDIA earlier in the day, the S&P would have been deep in the red earlier, and the NASDAQ and SOX would have been barely break even. The breakdown that we're seeing in those broader market names right now, indicative of some of the concern. And some of that concern and some of the lackluster broad market moves are less about NVIDIA and more about some of the economic data we got this morning, including the latest U.S. manufacturing PMI numbers. That data showed a sharp acceleration in business activity. Good. But that suggests not only greater inflationary pressure, but price pressure that is now coming more from the manufacturing side rather than just on services. And maybe that explains why so many Fed speakers in recent days and weeks have really been so intent on saying they want to keep interest rates higher for a little longer. That led to a modest sell-off in treasuries, and of course it did dampen the moves in equities in a big way, particularly for the industrial and cyclical stocks. Take a look at the Dow Transports, on pace right now for their second worst week of the year. In fact, two stock market gauges that together, when intertwined, provide a real clue about the state of the economy are now flashing early signs of caution. The Dow Jones Industrial Average, which hit a record high last week, has not seen that move matched by the Dow Transportation Average, which is still, Alex, 12% below its all-time high that was set all the way back in late 2021.
Yep, and it raises the question, are we a transportation economy anymore or straight up services? This is a great chart sort of illustrating what Romaine is talking about. You have the white line, which is the Dow Jones Industrial Average, and the orange line, which is the Dow Jones Transport Average. And I did it for 2 years, so you get the sense that they tend to move together. Sure, there's been some dislocations, but on the whole, they move together. The recent dislocation so far this year has seen the Dow Jones Industrial Average really outpace where we are for the transports. So either the Dow Jones Industrial Average is going to come down, Romaine, or we're just in a different type of economy. We're into services. I'm going to get my massage. I'm going to a restaurant. I'm not going to be buying big bulk items.
Yeah, absolutely here. And it gets to the broader question, too, as an investor. How do you position around that? Ed Yardeni joining us right now is President and Chief Investment Strategist over at Yardeni Research, helping us kick us off to the close. And, look, Ed, I don't want to get too into the weeds of Dow theory. I know there's some big believers in that and, of course, a lot of naysayers. But right. One thing I don't think is debatable right now is that there had been this sort of disconnect, I think, between what was going on in the manufacturing part of this economy and the services side of the economy. Is that a concern?
It really hasn't been a concern to us. We've been anticipating and perceiving that we're in a recession, but it's been a goods recession. We had that massive buying binge after the lockdowns were lifted, where people wanted to go out and shop. They couldn't really do much in services. So we saw just record spending on goods. And then it all kind of came to a halt in around March 2021. So everybody got loaded up with goods, bought what they wanted. Then they started seeing that the services were opening up. What's interesting is the goods didn't take a dive. They just kind of went sideways for a while, and they're still going sideways. And anything related to goods like trucking, like train transportation, has been also kind of in a stalled state. So that's the weak part of the economy. The services is doing absolutely fine.
Well, then that gets to the question, though, too, as to which direction the signals are going. Are we learning more about the economy based on what we're seeing in markets, or are we learning more about markets and that psychology based on what we're seeing out of the economic data?
Well, the economic data still looks pretty good to us. The initial unemployment claims came down again. There was some concerns that maybe it was about to swing to the upside. But the initial claims, I think, are the key weekly indicator that we have on the labor market, which is the key leading indicator that we have on the consumer. And the consumer looks fine. They're still getting jobs. There's still plenty of job openings. Small businesses are depressed, not because their business isn't good, but because it's hard to find workers. So all in all, I think we're looking at an economy that remains remarkably resilient. And while everybody's coming to conclude that maybe we're going to have higher for longer interest rates because that's what Fed officials are signaling, I view it as normal for longer. We're at normal interest rates. Economy's done fine with these level of interest rates, as has the stock market.
I think that's a great point. Normal for longer. That's a total mindset shift, it feels, than like getting a few more cuts, right? In that environment, what still gives you the most value? Where can you still find value in a normal forever?
Well, I think at this point, my advice to people who've been investing in the market is stay with it. I still like information technology, industrials, financials have done very well. I mean, there have been some laggards, I suppose, in the financials. Biotech has had a bit of a move here. But all in all, I'm kind of anticipating that the U.S. economy is going to continue to do well. We are starting to see some green shoots in the global economy. So I think all the stocks that are being sold today are probably the ones that are going to make a comeback. And maybe this is just a short-term opportunity to hop aboard what I think is a long-term bull market.
Does that include small caps right now, Ed?
Well, it's interesting. We've looked at the earnings story on the small caps. We're talking about when, there's the S&P has 500, the 400 is the mid caps, and the 600 is the small caps. We're not big fans of the Russell because they got like 2,000 names in there, and a lot of them, quite a few of them aren't making money. So the S&P 600, the small caps, their earnings are kind of flattish. I think they're still more exposed to higher interest rates than are the large caps, and they're, I think, having more troubles finding workers, and they're finding it harder to use technology to increase productivity. So I think at this point, stay with the large caps, but I think if you want to go down the cap range, I would go to mid caps, and they've done very well too. Information technology mid caps have been on fire.
All right, Ed, it's always good to catch up with you. Thank you so much. I know you're six on that 60,000 for the Dow 2030. Doesn't look so crazy right now, Ed. Thanks a lot, Ed Yardeni.
Thank you.
President and Chief Investment Strategist over at Yardeni Research. Have some breaking news for you. So Starwood REIT is setting some drastic redemption limits amid an ongoing liquidity crunch. This is a $10 billion fund managed by Barry Sternlicht's Starwood Capital Group, and it's taking the drastic step of preserving liquidity by imposing tighter limits on investors' ability to pull the money. It's going to cap monthly redemptions at 0.33% of its net asset value and 1% a quarter. This is according to a filing on Thursday. Of course, this all comes within the depths of commercial real estate property crunch.
Yeah, kind of reminiscent, I think, what we saw last year with Blackstone, the B REIT there. Maybe not as dramatic in terms of the shutting people out here, but that's a pretty big drop when you talk about allowing a 2% redemption and then going down to 0.33% here. It's sending a signal. I was just taking a look at the complexion of S-REIT here, still very heavily weighted to market rate apartments and primarily in the southern parts of the U.S. The story we'll keep an eye on here, as maybe there are still some pressures going on out there in the real estate market, but also some pressures going on when it comes to antitrust. The DOJ here in the U.S. and almost 30 states suing now, formally suing to break up Live Nation. They want to force it to sell off Ticketmaster. We're going to talk with a key official, one of the lead attorneys in the antitrust division of the Justice Department.
And plus, we're going to take a closer look at NVIDIA's strong results and why it's not having a positive impact on the broader market today.
And we're going to take a look at some of the big movers on the day, and that includes VF Corp, the owner of North Face and Vans, plunging after reporting a quarterly loss. We're going to take a look at the challenges facing the company and other apparel brands. All that and more coming up in a bit. This is The Close on Bloomberg.
Live Nation Ticketmaster's exorbitant fees and technological failures have been criticized by fans and artists alike. But we are not here today because Live Nation Ticketmaster's conduct is inconvenient or frustrating. We are here because, as we allege, that conduct is anti-competitive and illegal. Our complaint makes clear what happens when a monopolist dedicates its resources to entrenching its monopoly power and insulating itself from competition.
That was U.S. Attorney General Merrick Garland announcing the Justice Department's decision to sue Live Nation with the aim of forcing it to sell Ticketmaster. Nearly 30 states are also joining in that suit. Joining us now from Washington is Andrew Forman. He's Deputy Assistant Attorney General for the Antitrust Division of the Justice Department. Andrew, thank you so much. I'm going to read you Live Nation's statement, if you don't mind. This is what they said in response to the lawsuit. The DOJ lawsuit won't solve the issues fans care about relating to ticket prices, service fees, and access to in-demand shows. Calling Ticketmaster a monopoly may be PR win for the DOJ in the short term, but it will lose in court. Andrew, what's your response to that?
Yeah, well, first of all, thanks for having me. Look, as you pointed out, the Department of Justice, along with 30 states, a bipartisan group of states, I might add, filed the lawsuit today. Look, we start from the premise that competition matters and is meaningful. And as illustrated in the complaint, we lay out why Live Nation has, in our view, a dominance across the entire concert ecosystem, from its promotion services, from its aspects of its venues, and its ticketing business. And we also allege several different categories of conduct that we believe shows that they are maintaining that monopoly unlawfully. And so, again, in our view, competition matters, and we look forward to discussing that in the courtroom.
I mean, it seems what Live Nation is saying is like, look, the reason why ticket prices are high is because there's a lot of demand. Splitting us up isn't going to do that. Some analysts are also calling it a political stunt. What's your response?
Well, look, I'll leave the that to them. I will say again, along with the Department of Justice, there were 30 states that joined the lawsuit. That was a bipartisan group of states. And as we lay out in detail in the complaint, we believe that because of Live Nation's power across the concert ecosystem and its conduct, that has led to a series of harms, and those harms flow to fans, artists, and others.
And you feel like you can actually prove that in court?
Yeah, look, we do thorough investigations, and we follow the facts and law where we see fit. And when we believe there's a violation, we bring a lawsuit like we did today. Did
you actually try to negotiate a settlement with Live Nation before announcing this lawsuit today?
Yeah, look, I don't want to get into any specifics, but I will say, we, consistent with ordinary practice, we had discussions with Live Nation. And nothing out of those discussions, stopped us at this point from filing the lawsuit that we did today, along with our state partners.
There's a big question right now here, not just with DOJ, but really about the broader antitrust efforts coming out of the U.S. And the track record, the success, or rather lack thereof, in recent years in that. So when you see a company not necessarily willing to settle prior to the lawsuit, willing to take this to court and fight, how long are you prepared to wage this fight?
Yeah, thanks for the question. I just want to maybe nitpick a little bit on one of the assumptions in it. We have won our last 3 trials, thanks to the great work of the people of the Antitrust Division, and have seen a whole lot of other enforcement victories. And so, we don't take actions like we took today lightly, and we've got tremendous lawyers, economists, and others at the Department of Justice, and we look forward to having our day in court.
If you want an asset sale for Ticketmaster, how does that happen, or how quick can that be? We have analysts here at Bloomberg that said that it could take years and that it might not even result in a forced asset sale. What's the time frame for something like that?
Yeah, so look, we obviously just filed the lawsuit earlier today, and as the Attorney General and Assistant Attorney General Cantor laid out, we did ask for structural relief in the complaint, and any effective antitrust remedy needs to address the violation. There's a long history of structural remedies in antitrust monopolization cases. And so, but we're just in the beginning of the litigation here. And,
Well, Andrew, I do want to ask you, we only have time for one more question, but I do want to ask you just to kind of about the origins of how this sort of mashup of Live Nation came to be. I mean, the whole purchase of Ticketmaster several years ago during the Obama administration was scrutinized primarily for the same issues that Merrick Garland laid out today. Yet that deal was approved. And I'm curious as to what you think has changed in that sort of, 10, 12 years, however long it's been since then and now, that sort of gives the DOJ the confidence to sue over a deal that effectively they were willing to sign off on back in the day.
Sure. So our lawsuit today is much broader in terms of the markets, in terms of the conduct that we talk about. It is under different laws. It's under the Sherman Act. The transaction that you talked about was scrutinized under the Clayton Act, a different law, and obviously was narrowly focused on the transaction itself. So this litigation is much broader and, as I said, under different laws.
All right, Andrew. Well, we really appreciate you taking time to talk to us today. I know you're busy. Andrew Forman there. He's the Deputy Assistant Attorney General for the Antitrust Division of the Justice Department, one of the lead lawyers here on the Live Nation Ticketmaster case. All right, when we come back after the break, we're going to focus in on another company, and that is the parent company of the apparel brands Vans and the North Face, VF Corp. It's finding itself in a bit of a pickle last quarter and getting 2 downgrades as a result. We're going to talk to one of the analysts behind those calls. That's coming up next. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Take-Two Interactive, an upgrade to buy over at Bank of America. The price target getting lifted to 185 from 160. The analysts citing better clarity on the release dates for some of Take-Two's popular games, Borderlands 4, Civilization 7, and of course, Grand Theft Auto 6, now all set to have the release time sometime in 2025. The shares today up about 0.9%. Under Armour next up here, Oppenheimer cutting to market perform. The analyst waiting for clearer signs of improvement on that turnaround there. He says the backdrop for sportswear is still looking less and less favorable, with choppier consumer demand and markdowns hindering prices. Despite this, though, he's still optimistic about Under Armour's longer-term outlook, especially with founder Kevin Plank back at the helm. Those shares, nevertheless, though, down about 4% here on the day. And let's end things off with VF Corp here. This is the owner of Vans, the North Face, and Supreme. A big sales miss in the fourth quarter, prompting 2 analysts to cut their recommendations today. That includes Williams Trading, which downgraded to sell, saying it has a long way to go before that company's core brands can overcome consistent weakness. Even if VF sells some brands, it might not be enough to pay down the company's extensive debt load, the analyst adds. And you see the shares there down about 3% here on the day. Those are some of our top calls, and we want to stick with that last one because I'm pleased to say that the analyst behind it joins us right now. Sam Poser is Senior Equity Analyst covering footwear and apparel at Williams Trading. And you got a sell rating on this stock, Sam. You're one of only 2 folks on the street brave enough to go all the way down to sell. What's giving you the most concern here?
My concern is that I don't think, even with a lot of the changes, that they've got a long way to go. I don't think they fully understand that, once they've been kicked out of retailers, it's hard to get back in. And I'm not really sure, one, if they're going to have the product and the marketing set up even a year from now with the core brands, with Vans and Timberland specifically. North Face is doing well, but I think everybody's taking a very, very cautious look at this fall, given how poorly outerwear performed last fall. So I just think that to get the open to buy, to bring product in, and for it to sell well, unfortunately, I think that the sell in when when they feel they
Yeah.
get to where they need to get to, is going to outpace the sell-through.
But this gets to a question, though, about management, Sam, because, I mean, look, I think anyone would sort of quibble with the idea that these are iconic brands, and we've seen sort of storied brands fall out of favor and then sort of bounce back up here. You got a relatively new CEO who's been there a year. There were a lot of questions as to why he was qualified to run this company. Do you have confidence in him? And if not, who would you have confidence in to execute a turnaround?
Well, I sort of go in the I know it when I see it, and I mean he's had a good result at Logitech, and as I wrote in my note, there's not a lot of fashion risk to a keyboard, and I believe that they got rid of the person that was best suited to turn around Vans. He had left, he went back, and in the middle of the turnaround, they moved him away, and he just recently left the company. Timberland, since they bought it, it has not done much of anything, and I think they're overzealous on the iconic wheat boot and derivatives of that versus broadening out the offerings. Yes, some of these brands are doing a little bit better in the international markets, but I think that unfortunately is more of a flash in the pan than long-term success. And then, I am concerned also with the North Face that it might be needed to carry, more weight than it should in order to, help offset the weakness in the other brands.
Sam, I think that Apple would disagree with your, keyboard point. They probably definitely think the keyboard is an art form. But aside from that, what brands do you think that they will have to sell or should sell? I appreciate that won't be the fix, but what do you think?
I think that they'll probably sell Supreme, not necessarily because it's bad. I don't know if it was a great acquisition, but because it's probably more of a one-off relative to their core brands. It wouldn't hurt their strength with their factories and so on. And secondly, it would probably be Dickies for virtually the same reason. However, that being said, as Timberland has been, nothing since they bought it, many years ago now. It's up about $100 million in sales, and really, I believe, has lost its luster. And they've tried all kinds of things to get it back, and it hasn't worked. And for me, that's the one they really, should sell, because it just seems to be a waste of time, even though I think it's potentially a good brand. Unfortunately, with all of these, I'm not sure who the buyers are. And with Supreme, it's one of those peculiar situations. It did exceptionally well because it was so scarce. And as you open more stores and expand it, you do more business, but you also diminish what made it great in the first place.
Yeah. No, it's a conundrum, and then you overlay it with a challenged consumer. All right, Sam, thanks a lot. Sam Poser over at Williams Trading. Appreciate that perspective. All right, coming up, we're going to talk to Larry Morse, co-founder at Fairview Capital. New York Life just acquired a minority ownership stake in the firm. We'll break it down. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So you may have markets actually disappointing investors today, particularly if you were looking for an outperformance. But here's a fun stat for you, Romaine.
What's that?
Fidelity says the number of 401k millionaires has now hit a new record. It's jumped 15% from the prior quarter and up 43% since March of 2023.
And I assume that's because of all the rallies that we've seen in equities and other asset classes.
I don't know. Maybe they're invested in some private credit. Maybe they're doing alternatives in their 401k. Could happen.
I know. Have you looked at some of those offerings that we get now here? I mean, it's broadening out here. It's not just the old 60-40 with stocks and bonds. Of course, alternative investments have been a big part of that strategy. And when we talk about sort of the whole universe of private capital, we also have to talk about insurance companies. Traditionally, they've invested mostly in bonds, stocks, and mortgages, but increasingly, they've actually been taking a more active role in investing not just in alternative assets, but in the asset managers themselves. That includes private equity and venture capital firms. One recent example is New York Life, which increased its investment in Fairview Capital, acquiring a minority ownership stake in the Hartford, Connecticut-based firm, which has about $10 billion in assets under management and focuses on venture capital and private equity. Pleased to say that the co-founder of Fairview joins us here in Studio 2, Larry Morse. Great to have you here, Larry.
Well, thank you for having me.
First, let's talk about why. you sold this minority stake. Your firm's about 30 years old right now. You've been doing this for a while.
That's right.
What made it attractive to you?
Well, a couple of things. And I have to say that there was something quite organic about this from our perspective. As you referenced, New York Life was an existing investor of Fairview's. Back in 2021, they retained us to build a portfolio of next generation private equity fund managers. Those that we've identified as having the talent, the ability, the performance that suggests they're likely to build enduring franchises over time. In that process, we worked very closely with the team of professionals at New York Life. They got to know us, we got to know them. We developed deep respect for one another. We understood our capabilities, our compatibilities, our complementarities. So when they broached the notion of deepening the relationship and suggested to my co-founder, Joanne Price, and I that if we were ever interested in a strategic conversation, that was a conversation they'd like to have. We decided we'd pursue it.
Let me ask you this.
Yeah.
Why do you think they wanted to have that conversation now as opposed to, I don't know, 5 or 10 years ago? What's changed?
Well, look, if you've been paying attention to what's going on in the asset management industry, broadly speaking, consolidation has been underway for some time, and it's driven primarily by large institutional investors who are making it clear that rather than dealing with dozens of specialists in certain categories, they'd much prefer to deal with a handful, if you will, a few large service providers who offer them a broad portfolio of investment options. We do some things that New York Life historically has not done. They've not been particularly prominent in venture capital, for example, growth equity, smaller end of the buyout spectrum. And I think getting to know us and understanding our strengths in that area was attractive to them.
What kind of opportunities do you see right now within this market? Like I could see insurers being interested, for example, when rates were really low, right? Because you got to find some way to make return.
Sure.
But now that rates are higher,
Right.
is the competition that much more fierce for you?
Well, yeah, it is. But if you think about, the industry long term, if you will, let's look back over 30 years. There have been cycles before. There have been times when the industry has contracted and then broadened again. We had the nuclear winter in venture capital in the late 1990s, early 2000s. So there's some dimensions of what's going on now that are not, all that unusual, if you will. We've weathered these kinds of things before. Is it likely that there will be some shrinkage in the business in terms of number of actors, if you will, because of the difficulty of raising private capital at this point? Probably. But will the industry survive? Will it continue to prosper? Absolutely, because it's driven by technological innovation, essentially. Yeah.
So that brings me to a point that I think about a lot in terms of different areas of the market, and that's the structural shift, but still a cyclical market. So we've seen ups and downs before. That's a cyclicality part of it. But
Yep.
what are the structural shifts within your industry that you're noticing?
Structural shifts that I'm noticing.
Or even trends within investment opportunities?
Well, essentially, think about it this way. I mean, the venture capital industry in particular thrives on waves of innovation. I mean, we had cloud, we had SaaS, we had mobile. Now we've got AI, something that clearly is going to impact all industries, going to be transformative in some cases. We are certainly seeing interesting developments, if you will, in that area. We started paying attention to AI a decade ago. Across the stack, infrastructure, middleware, applications. You're only now beginning to see new applications, if you will, emerging. But we're in the very early innings of that. That's likely to be, sort of a multi-year investment curves, if you will, with respect to what's going to happen there. So obviously we're paying close attention to it.
I understand, though. I mean, and Fairview, I mean, you guys have always had a certain degree of patience on these things. But is there a sense of urgency with regards to the AI question? Because there's so much money sloshing around right now, and everybody wants to be first. Everybody wants to make sure that they're in on the ground floor. So does waiting, at least for a wave like this, does that hurt you at all, or are you not concerned?
Our view of it always is that patience and discipline will ultimately win out. And that's our posture with respect to this. As I said, at the time that we began paying attention to it, I don't know that it was on very many people's radar. And obviously, we've invested in some firms that are specialists, some that are focused more broadly. But there will be years of investment opportunities coming off of this particular.
Is there something, though, that catches your eye right now, even if you're not actually invested in it, but maybe at least intrigues you?
Nothing that I could speak about.
Nothing that you could speak about.
Sure?
Only when the
It's just
camera's
us.
off. I mean, yeah, it's just us three here. I mean, you know.
The other and this is sort of pairing technology with my world. I cover energy
Sure.
and the energy transition and sort of greening. That also has a VC component because there's a lot of small startups that are like, look at this cool thing that I can do with carbon, et cetera.
Right.
Are you into that area at all? Do you see opportunities there, or is it just too much capital chasing the same kind of thing?
Well, certainly climate VC, energy VC, or areas that are receiving some attention, if you will, at this point in time. We have not made definitive commitments to energy VC or to climate VC. Having said that, though, in some of the generalist funds in which we participate, we do see one-off climate and or energy focused deals. Battery is a big topic right now, obviously for lots of reasons. So yeah, that would be how I'd respond to that.
All right, Larry, this was great. You've been doing this a long time,
Yeah.
30 years.
Yeah.
What are you doing next? You're not going to continue doing this forever, are you?
Oh, you know, that's an interesting way you put it.
Yeah.
One of the things that's really exciting for me
Yeah.
right now, quite frankly, is observing this next generation of firm leaders moving into position and continuing to grow and build Fairview. For my fellow co-founder Joanne and I, nothing could be more gratifying. And this development with New York Life aligns them in such a way with where the industry is going that we think will be very healthy for Fairview and certainly offers a bright future for all of them.
All right, Larry, that's a great way to end it. Larry Morse, the co-founder of Fairview Capital. Alex?
All right, coming up, we got chip makers feeling the burn today on the heels of NVIDIA's results and concerns of a slowdown in AI growth. There's more on that in the stock of the hour that's coming up next. This is The Close on Bloomberg. NVIDIA earnings did not give that big pop that the overall market was hoping for. It's dragging down other AI stocks. Although I should point out the semis did wind up hitting a record intraday. NVIDIA also hit a record. But you got AMD, Supermicro, Computer, Broadcom. They're on the back foot. PC maker Dell seems to be a one bright spot still. It is the focus of today's stocks of the hour. Joining us now for more is Bloomberg Technology co-host Caroline Hyde. So we had optimism in the beginning of the day, right, for like a moment that these stocks would start to perform with NVIDIA. And then what happened?
Well, NVIDIA's still higher, and it's still adding more than an entire market cap of Intel on the day by the fact that it's up about 9%. So yes, the enthusiasm there. Maybe competition is actually there still. The AMDs of this world, the Intels of this world, are still not managing to really encroach on just the leadership that NVIDIA seems to have with its incredibly high specification architecture, chip architecture, and chips moreover. And I think we did see boats rise over in Asia, for example. TSMC, big provider, big builder of the chips that NVIDIA is making. So too is SK Hynix, for example, producing what is needed within some of these incredibly powerful productions that we see. So NVIDIA, as you'll see, up more than 100% in the last 12 months, this year alone. In the last 12 months, it's up 200%. Why? Because its revenue is up 200% over the last 12 months. And it's seeing extraordinary growth continuing. They still speak of the way in which AI is going to percolate every area of our life.
Well, let's talk about that, other areas of our life, and hopefully we can find other stocks to invest in other than NVIDIA, Microsoft, and Alphabet on the AI front. You actually had a chance to catch up with John Stankey over the CEO of AT&T.
Yeah.
He seems to think this is going to be a benefit, AI is going to be a benefit for AT&T. Explain that to me.
If he can get the spectrum. So already we've seen utilities pop because of the energy demand. Well, now will we see telecoms pop? Because he's saying at the moment they've seen a 30% increase in wireless demand because we're all using ChatGPT, we're all using Perplexity, we're all using AI functionality on our phones. For that, you need wireless. For that, you need more spectrum. Here's what he had to say.
Well, wireless demand's up 30% a year, and it's not slowing down. And I think as you start to look at where we are with what's occurring from a usage perspective, you start getting workloads that come out of AI, it's going to continue to fuel that. And really, it's one of the key things that this country needs to deal with is if you're going to continue to see usage go up 30, 35% a year, you got to build bigger highways to take that. And that all comes on the foundation of spectrum.
key for John now is how does he get us to realize we've got to pay for it?
Well, that's the thing. It's like, so we're going to be using a lot more data. We're going to use a lot more electricity and power. Like where's this money coming from?
Where are the resources
Is this going to come from us?
Yes. I mean, particularly when it comes to utilities, they're regulated. So, like, if they want to pay more, it's going to go onto our rebate. So, how's his messaging on that in terms of paying more?
Well, fascinating from the regulatory perspective, because we are seeing, once again, the FCC putting in documentation, wanting to see oversight of broadband, ultimately deeming it some sort of a utility. Thus far, we have no federal regulation for broadband, for wireless. But his point to policymakers is allow us to access more spectrum. They have to pay for it. And they're going to be investing billions of dollars. And they continue to do that to try and open up their wireless and with the hardware and the software that goes into it with a $14 billion relationship with Ericsson. But, well, I think perhaps we're all going to have to realize that our own contracts are going to go up a little.
Yes, absolutely. I feel like everything's going to go up. All right, Caroline, thanks a lot. Caroline Hyde, co-host of Bloomberg Technology. Really appreciate you sticking around for us there. Quick update on the market. Volume's kind of picking up at this moment. We are still seeing, though, a decline in the equity market. The S&P and the NASDAQ appear to are off the lows of the session, but it's not a great day. Not the day I would have expected after yesterday's numbers.
Yeah, not a great day at all here. We were looking for that upside catalyst, and when you look at the overall complexion of the downdraft here, not only, of course, are those tech stocks moving lower, but then you had, again, all those sort of cyclicals and the sort of broader stocks that had been doing well, at least prior to this week. And I don't know, there's just no juice there. So what's left?
Yeah.
Fed speak?
Oh, yeah. I don't know. Maybe it's spring break until Jobs Day, June 7th. Wouldn't that be fun? All right, we're going to count you down to the closing bells. Kara Murphy, CIO over at Kestra Investment Management, will join us next. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele with about 10 minutes till we get to those closing bells on a day that was, I think, supposed to be a little bit more positive, at least based on what we saw last night out of NVIDIA. But other than NVIDIA and a couple other companies, that's pretty much it.
Yeah, I mean, the stocks did make a record. The semi index did hit a record earlier, but then now we're pretty much trading flat. S&P around the lows of the session. The NASDAQ 100 down 0.3% there. You also have the Russell getting hit really hard. It was pretty ugly. And then forget about the Dow, and we'll talk about this the next hour too, but Boeing really dragging on that index as well. So it was much more relatively broad-based. You could also make an argument, though, let's just take a break. Like, we got through NVIDIA, nothing bad happened. Let's take a break in the market.
Yeah, and of course, some of the downdraft you're seeing is because people look past NVIDIA and they looked ahead, of course, to that economic data we got this morning, which suggested that inflationary pressures are still real. But we had a chance to catch up with Ed Yardeni, and we asked him what he thought right now about the strength of the U.S. economy. Here's what he had to say.
All in all, I think we're looking at an economy that remains remarkably resilient. And while everybody's coming to conclude that maybe we're going to have higher for longer interest rates because that's what Fed officials are signaling, I view it as normal for longer. We're at normal interest rates. Economy's done fine with these level of interest rates, as has the stock market.
And that was Ed Yardeni over at Yardeni Research, helping us kick you off to the close just about an hour ago. And here to help take us to those closing bells is Kara Murphy, CIO over at Kestra Investment Management. And Kara, I do want to ask you here about kind of the overall disappointment when it comes to NVIDIA being a market catalyst. There are a lot of people looking at the calendar. They're saying earnings season's over. A lot of the big economic data, we got to wait a few more weeks for that. The Fed has made it clear it's not going to do anything anytime soon here. So where does that leave the market in terms of an upside catalyst that could propel this market to maybe another record high?
Yeah, and I think you can add to your list high valuations, right? So the early part of this bull market has been driven by improving valuations. So if you look at all that long list of things, what you need at this point in the cycle is to have earnings really take over. And the good news there is that I would agree with Ed Yardeni's comments in that the economy has actually been much stronger than forecast. So if we look at GDP expectations for this year, they've essentially doubled. And so there's a fair amount of economic momentum that is starting to flow through to company balance sheets and earnings. So over the next 2 quarters, if companies can continue to hit and possibly exceed those expectations for the second half of the year, I think that's where you start to get some more of that continued momentum in the market.
You've seen all the big gains in equity markets so far this year. We're coming up right now, end of May. So the second half of the year isn't far away, Kara. Have you made any sort of material adjustments to your allocations? Where are you overweight right now? Where are you underweight? And what type of changes have you made?
So in general, we're overweight equities relative to fixed income on a lot of that thesis that economic growth is continuing to be better than what was expected. We did earlier this year move out of some mega caps into some lower cap names. We think mid cap in particular is a really interesting area to fish. You can get out of some of that higher valuation. You can traffic in an area that's been sort of overlooked by a lot of institutional investors. And then within equities, we're taking a bit of a barbell approach. So overweighting things like technology, which have a tremendous amount of momentum. We saw with NVIDIA today, really strong continued profit margins and earnings expectations going forward are looking better. But then the other end of the spectrum, you have things like energy and infrastructure, which again have been a little bit forgotten or quite cheap relative to valuations and have some good secular stories.
You're speaking my language. The secular stories, but they're also cyclical, so then you have the opportunities. You mentioned mid caps. What about small caps? I feel like the Russell can't make up its mind about how it wants to go this year.
You're absolutely right. And so I think as we look at these dispersions in terms of valuation, the further down cap you go, the cheaper you get. But it also gets a little bit more difficult or tricky to sort of pick names. So we do like small cap, but the further down cap you go, because you get, you have to be more selective in the stocks that you choose, you need to lean into quality a lot. And that quality is going to help drive you towards companies that have more sustainable earnings, better balance sheets. And I think if you go down into that area, you can find some really interesting names. You just have to be more careful about it.
What you mentioned that you still prefer equities versus, say, fixed income, right? That you're overweight. But yet fixed income still yields quite a juicy bit. I mean, the 2 years almost at 5% again. I feel like the last couple weeks have been kind of a stealth move higher within yields. Do you need to barbell some kind of fixed income on that, Kara? And where would you do that on the curve?
Yeah, and just because we're underweight fixed income doesn't mean we don't also love bonds. We think there are some really good opportunities. As you mentioned, when we look almost anywhere in fixed income, you're finding yields that are far higher than what we've seen on average over the last 10 years. So we particularly like credit. So again, leaning into those companies that are higher quality, that don't rely on a huge amount of credit, that can deal with these higher rates, and avoiding things like high yield, where you have rock bottom low spreads and high interest rates. So you start to call into question the credit quality there. But we think there's still some plenty interesting areas.
So is that tied, though, is that thesis, is that tied then to your economic theory, your economic sort of outlook as well?
Absolutely. So there we think, there's a bit of a normalization of the yield curve that has to happen. And often you can manage that a little bit in terms of duration. So if we expect to start to see somewhat of a normalization of the curve, and now we think that's going to take a while, but we want to be in the belly of the curve where you can get a lot of those gains as the curve starts to normalize. You stay in the higher quality areas. And then, of course, you have a nicely diversified portfolio.
And Kara, are clients, I mean, are they asking you for any sort of material changes right now? I mean, there's been so much talk about market psychology, and you can take the comment from Ed Yardeni that we played before this, the idea that you do have an economy, at least is sound. I mean, there may be some disagreements along the edges here, but it is sound. But people have different perceptions of that right now, and that has to be shaping what investors are doing, and more importantly, what they're asking you to do.
So I think the most interesting shift over the last couple of months has been this increasing focus on politics. And this is not unusual, right? Heading into an election year, we start to see people focus more and more on the election. There tends to be a lot more uncertainty, a lot more anxiety. And so we've seen, even just over the last month or two, more and more individuals starting to ask us about our outlook for the election and the impact on the markets. And the good news there is that we don't think the outcome of the election has a big impact on the markets. And in general, whoever gets elected actually doesn't have that much impact over the long term on a broadly diversified basket of stocks. And if anything, you don't want to sit out the market during the election because the market tends to start moving up before the election actually happens.
All right, Kara, we're going to have to leave it there. Love to talk to you always. Kara Murphy, CIO over at Kestra Investment Management, helping us count down to the close. Alex, with just about 2.5 minutes to go here. Stocks still remain on the back foot with the S&P down about 0.8%, but the real decliners today in that small cap and cyclical space, the Russell, the S&P 400s, Dow Transports, et cetera.
Yep, and you got Live Nation and Boeing really weighing heavily there on the S&P. Stuart Kaiser at Citi, did you see his note? Basically being like, spring break, man, spring break until jobs day.
That's the other thing, too. I forgot to ask her about the catalyst. I mean,
exactly.
It's Memorial Day. We're heading into the summer season.
Bye, volume.
Anyway,
see you
a lot
later.
going on, or maybe not a lot going on, but stick with us. We're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Massar and Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms. That includes television, radio, and our audience on YouTube. Carol,
yes.
On a day where it looked like the equity markets were going to stage a pretty decent rally on the back of those NVIDIA earnings, but that faded pretty quickly in the day here. Broader concerns right now about inflationary pressures.
Yeah, some hotter than expected, right? Manufacturing data here in the United States, and then everybody starts to get a little bit worried. Certainly, we also got weekly jobless claims, but some concerns that maybe things are still continuing to be a little bit hotter than everybody forecast. And so what does that mean? Maybe we don't get a rate cut anytime soon. Maybe not even this year.
Can you believe how far we've come in just a few months? I mean, at the beginning of the year, at the end of last year, we were talking 5-6 rate cuts. And now we see markets move like this on a day when, okay, people reset their rate cut expectations from maybe from November to December for one cut this year. Or maybe, Alex, none at all.
It was so thoughtful. Like, can we think about where we've come? I can't remember yesterday, so I don't know what that's about. But and Romaine and I were just talking about before too. Like, what is the next catalyst then? Like, you get Memorial Day, it's the summer. Volume's going to go down. You get Jobs Day on June 7th. Like, is it just going to be hang tight? See you in a couple weeks because there isn't anything else to move the market.
9 days to the blackout.
What about the
9
next
days
Fed
to the
meeting?
blackout.
Yeah.
I keep counting down. I'm
June
looking
12th?
for something.
I don't know.
Oh, blackout for the Fed speak?
Yeah, she has
I see. Okay.
She has a
okay.
count.
Yeah,
That's
I was a
how
little confused.
I
Too.
make
I was
fun
like,
of her
does
because
Carol
she has
know
a
something we
countdown.
don't?
She
Are
has
the
a
utilities
countdown.
cutting power?
So Carol,
Sorry.
that's all right. Carol Thanos Massar there, apparently predicting the end of the Earth. But nevertheless, Earth continues to rotate. Although stocks not necessarily along for the ride, at least not for this particular day. Let's start with the S&P 500, a drop of about 0.7% or 39 points here on the day. You had a similar move lower on the NASDAQ. The NASDAQ Composite down about 0.4%. The NASDAQ 100 down about 0.4% as well. Again, the ballast that we got from NVIDIA just not enough to really overcome the huge drag that we got elsewhere, particularly in the cyclical space. You saw that in the Dow Jones Industrial Average, lower by more than 600 points or 1.5% today. You saw that in Dow Transports, lower by 186 points or 1.2%. And you saw that in the Russell 2000, Carol, down 33 points or about 1.6%.
Yeah, the equity tone very clear on this Thursday, folks. S&P 500, most names in the index losing ground today. 449 names to the downside. Tim, 54 to the upside. So definitely a risk-off trade here.
Still getting earnings. Watching shares of Intuit, the company raising its fiscal year guidance. Third quarter net revenue coming in above estimates at $6.74 billion. Estimates were for $6.64 billion. Third quarter adjusted EPS coming in at $9.88, beating estimates of $9.38. Shares moving lower, though, in the after hours, down by 2.3%.
Also looking at Ross Stores here. So first quarter earnings coming in at $1.46 a share. That looks to have beat estimates. That was about 1.35. So just waiting for some more numbers to come by in here. But Ross Stores looks on an earnings level to have beat that stock just starting to trade in after hours. What else I got? Sales were up by about 8%, beating estimates. And you got merchandise inventories were up by about 10%. So relatively strong quarter, it looks like.
Yeah, and looks like inventories, while they are elevated, maybe that's sort of the setup for the season. Margins were up, as was store count. And it raises a lot of questions here about the complexion of the retail space right now, that sort of dichotomy between what's going on in the luxury space and what's going on the more affordable space at locations like Ross.
Exactly. Some commentary and context here coming from our team. Earnings per share for the second quarter projected to be in the range of $1.43 to $1.49, up from reported earnings per share of $1.32 for the prior year period ended July 29, 2023. The CEO weighing in, though we had hoped to do better, first quarter sales were in line with guidance despite macroeconomic headwinds that continue to pressure our customers' discretionary spending, which is something, Romaine, you were just talking about.
I do want to get back to shares of Intuit because they are moving lower in the after hours, despite the fact that the company raised the fiscal year guidance. It does see fiscal year adjusted earnings per share of $16.79 to $16.79 to $16.84. That came in above estimates of $16.42. Sees fourth quarter revenue about $13 to 14%. It also sees small business self-employment revenue up about 18%, but shares now down about 3.3%.
Yeah, it's interesting as you bring that up. I was just looking at Workday, the big application software maker, also reporting. And it was kind of a similar complexion as Intuit in that the numbers themselves weren't all that bad, Tim, but the shares are moving lower here in after-hours trading. So it seems like this is an issue, too, of not just about meeting expectations. You really got to beat, and you really got to beat big in this environment to get the extra pop in that stock, given how much valuations have risen.
Yeah, it looks also, though, that the small business and self-employed group, though, did really well, up 18%. Their consumer group was up 9%. But to your point, you really got to deliver if you're going to do really well on that. I also want to point out here, guys, that Boeing shares fell about 7.6% today, the biggest drop in about 4 months. So it's not just earnings that are coming through. It's also some individual company stories that are really weighing on that after their cash burn is going to be intense.
Yeah, I mean, the Boeing story is a big one, right? And that's exactly what weighed on the Dow Jones Industrial Average. So, yeah, we definitely saw that play out in a big way. Quick check on gainers, guys. NVIDIA. Surprise! Top in the S&P 500, the NASDAQ 100, pretty much holding on to most of the day's gains. At its highs up almost 12%, finishing, though, with a 9.3% gain. We know the story, topping $1,000 a share, up, I think, 109, 111%. The bullish sales forecast showing that AI computing spending remains strong. So that second quarter revenue will be about $28 billion, topping the $26.8 billion predicted by analysts. 10-for-1 stock split, the 150% boost in its dividend.
Mm-hmm.
Yeah. Oh, did you
That's pretty good.
Yeah. I mean,
so what happens? Does that mean that
you got to
the share price goes up?
Well, you got to sell the shares before June 7th, Romaine, or else the value of them is going to go to about $100.
Okay,
I'm just kidding.
I guess
it's a joke.
First I got to buy the shares.
It's a joke. I'm making a joke.
It's a joke.
We got the joke, Tim.
It's a joke.
Do you want the other gainers?
Yeah, I want the other gainers.
All right, synopsis. I'm going to
Is there a lawyer standing behind you or something, Tim? It was a good joke, and you stepped on it yourself.
It's a joke. It's a joke. It's a joke.
We're surrounded by glass. You never know who's peering over you, Romaine. That sometimes happens. All right, synopsis. Top gainer in the NASDAQ 100, folks. That was up 2.3%. Analyst positive. It's a chip design company, in case you didn't know. Reported second quarter results last night. Beat expectations. Raised its full year forecast. And you had a bunch of analysts, Morgan Stanley, Piper, raising their price target. So that one was up 2.3%. And Elf Beauty. I know that we talked about it a lot, I feel like, on the Bloomberg or in the Bloomberg universe today. This was up almost 19% in today's session, soaring. The company reported fourth quarter adjusted EPS per share. And net sales that came ahead of consensus estimates. It just did well. And basically, even though that there were some numbers, I think, that didn't meet expectations, analysts are generally positive, thinking that maybe they're a little conservative in their guidance.
Okay, you got the gainers, Carol. Yeah. I'm doing the decliners. I do want to start with Boeing. Alex, Romaine, you guys hit on it a little bit. Shares did fall by 7.6% today. The company did scrap a plan to generate cash again this year and said it will suffer another significant outflow. In this current quarter, it's fighting to get production back in order and ramp up deliveries in the wake of all the issues that the 737 MAX has had, not just this year, but of course in recent years. Also, we're checking in on shares of Live Nation falling 7.8% today. The U.S. Justice Department and close to 30 states suing the company, alleging a, quote, entrenched illegal monopoly over the live events industry and seeking to force the company to sell off Ticketmaster, which it bought a few years ago. Antitrust enforcers claim that Live Nation and Ticketmaster have engaged in a variety of anti-competitive practices, including locking venues into long-term exclusive contracts and retaliating against rivals and venues that seek to use alternatives. Shares down by 7.8%. You know what's funny?
No.
This is not, I mean, look, am I speaking as a consumer or as
it's choose your own adventure here.
Okay,
Tim,
choose your own adventure.
Yeah.
How do you guys feel about buying tickets for a concert that you want to see? Is it a good experience?
Well,
it's a pretty tough experience, right, Alex?
It's an expensive experience.
It's a very expensive experience.
And the whole idea of splitting the fees, where you go through the whole process and you think, oh, this is $100 ticket, and then when the fees get added, you realize it's like $150, and you're like,
yeah, it's pretty
I
out
don't
of
really
control.
like this band that much.
But look, it's supply and demand, right? I mean, people will pay, especially for big acts. I mean, Billy Joel,
but
Taylor
isn't
Swift.
the bigger issue? It's less just about the cost to you and me, but it's also about, at least based on what the DOJ is alleging, let's just make that clear, that there's a sort of anti-competitive nature in the structure of the business itself by representing artists, by owning the venues, by selling the tickets, et cetera, et cetera. They're basically have this from top to bottom, the entire supply chain, if you will.
So it's a good question to consider. If the Justice Department is victorious here, will the experience actually get better for consumers?
Right, and that's
Cheaper.
sort of the whole point
Right.
of antitrust stuff. But then again, you never know. And also, Bloomberg Intelligence was saying that this could take a very long time to even suss out. So in a spinoff might not even be valuable, you might not have a forced asset sale. So this is a slow burn here. This is not going to be a quick flame out.
All right, off to Friday we go. That's a wrap.
Get those Billy Joel tickets.
I mean, we have another hour of the show, Carol. I don't know where you're going.
Well, so do we. I'm just saying, we're done. We're done.
This moment is done.
For good.
I'm not done. I'm staying.
There she goes. There she goes. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Bye, Alex. Remain, you stay there. We'll stay there.
What?
Beyond the Bell. Oh, she stays there.
She's staying today.
Oh, you are staying
Yeah.
there.
Alex
All right.
is staying.
Beyond the
Just
Bell.
today.
We'll see you on Friday.
Just today, guys. All right, stick with us here. A lot more coverage coming up here on Bloomberg Television. We're keeping an eye right now on Ether. We're awaiting word here from the SEC on whether they are going to approve those new ETFs. Stick with us. We'll be back after the break right here on Bloomberg.
Oh, welcome back. This is me. Okay, I never do this hour. This is the close. I'm Bloomberg. I'm Alex Steele.
You are Alex Steele. I thought you were going to say
I
you're
am.
Scarlet Fu. You're
It's
a
very
little
possible I could
confused
say
because you're
that.
normally not here, but you are now in overtime, Alex Steele. This is where all the good stuff happens. I'm Romaine Bostic. This is where we take a look back at where the markets closed out the day here. And we talk about where we opened here, a market that looked like it was going to rally hard on the back of those NVIDIA earnings. But you see the numbers on the screen there. A big pullback by midday and by the close, down 0.7% on the S&P 500. Philadelphia Semiconductor Index that was trading at a record high at one point in the day, finishing the day in the red. Similar story for the NASDAQ 100 and the NASDAQ Composite as well. And of course, right now we are keeping an eye on the crypto space as well. You did see continuous activity there, but that was to the downside, both, Alex, on Bitcoin and on Ether.
So two interesting movers today, and they were both the biggest decliners within the S&P. Also, Boeing really helped to tank the Dow as well. Live Nation had the worst drop since February. At one point, the Department of Justice in almost 30 states suing the company, alleging an entrenched illegal monopoly over the live events industry. They're trying to get the company to sell off Ticketmaster. And Boeing, worst drop in 4 months, shares down over 7%, scrapping a plan to generate cash yet again this year, saying it's going to suffer another significant outflow in the current quarter as the playmaker is fighting like multiple fronts. Feels like an understatement. A lot of fronts. And our top story for the hour, waiting for the SEC. We are expecting a ruling from regulators any second now about whether or not they will approve a spot Ether ETF. Crypto markets have grown more optimistic since spot Bitcoin ETFs were approved back in January. But my question here for where does the extra money come from for that? Like, say we get the Ether ETFs.
Yeah.
Do you move out of the Bitcoin ETFs for that? Or is this draw in institutional investors or people like you and me in a different way?
It's a good question. I think the answer to that, and I'm just speculating here, I do think it's probably trying to get new investors, new retail and institutional investors who don't have that exposure. Maybe this gives them an opportunity to get it. We do want to go back to some of those earnings that we were telling you about in our Beyond the Bell segment, and that includes Ross Stores. The shares rallying here in after hours, trading up by about 6%. EPS in the most recent quarter coming in above estimates. Revenue in the most recent quarter also coming in pretty much around what analysts had expected. Mary Ross-Gilbert joining us right now, Bloomberg Intelligence Senior Equity Research Analyst. And Mary, we spoke to you last night ahead of this earnings report and got your take on what you expected. Was it everything you dreamed of and more?
Well, I wouldn't say it was everything I dreamed of, but I thought they might beat on the sales line, but they actually did. They didn't. They came in lighter than consensus. Their comp sales rose 3%. Consensus was looking for a little more than that, like 3.4%. But they did beat on the earnings line. And we sort of had an indication from them because they're carrying more of those wonderful brands that consumers want. I sort of mentioned yesterday about Michael Kors and Tumi being in there, and that they would offer them at sharper price points, meaning they would cut those prices a little bit lower so that that consumer would be enticed to buy. And so we thought maybe the margin spot would be hit, but actually they beat on the operating margin side, 12.2% above estimates. And then also on the EPS side, they came in above estimates and also above their guidance. They were looking for 129 to 134 and came in at 146. And then they raised their EPS guidance for the year, maintained their comp sales up 2.3% for both the year and for the second quarter. So, and also if you look at the second quarter guidance, that's also above consensus on the earnings line. So we'll learn more on the call that'll be coming up shortly.
All right, Mary Ross-Gilbert over at Bloomberg Intelligence. A nice breakdown here of the earnings that we got just now out of Ross Stores. And we should point out this week we've been getting a lot of earnings out of other retailers, other apparel makers, and that's going to continue into next week, including for names like department stores, Nordstrom, like Kohl's as well. David Swartz, senior equity analyst over at Morningstar, joining us right now to talk a little bit more about this. And I want to start off, before we get to the department stores next week here, David, I'm wondering if you could maybe compare and contrast what we're seeing in the more luxury end of the retail space, including like with Ralph Lauren reporting earnings this morning, and then what we're hearing from, I guess, more of the middle and lower end brands and companies like a Ross Stores. Are you seeing a significant divergence in the performance of these names?
Yes, we have seen that for some time. For the most part, higher income consumers have continued to spend, certainly in my area, which is primarily apparel. We have seen stronger results from higher-end retailers. For example, if you look at Urban Outfitters, the Urban Outfitters chain itself has been struggling, but Anthropologie and Free People have been doing much better, and their customers tend to be wealthier than for Urban Outfitters. Now, we have seen, though, some weakness in luxury, too. Nordstrom, for example, has not been doing well at all. In fact, Nordstrom Rack was a little bit better than the Nordstrom full-line stores last quarter. If you look at Macy's, certainly Bloomingdale's has been outperforming Macy's. Also, Blue Mercury, which is Macy's.
Oh, looks like we may have lost connection there. David, are you still with us? Nope, we're going to try and get him back for you. But the idea that within it, you have the high end still doing well versus the low end. And interesting that he mentioned Nordstrom's, because I just bought a boatload of clothes from Nordstrom Rack, which should just show that that's probably a little bit of an issue if you want to own the stock. David, so as an investor, how do you manage that?
Well, I think you need to look for areas that are doing better. If you look at Macy's, for example, Bloomingdale's is outperforming Macy's. So if you look at Bloomingdale's performance, that could be a reason to want to own Macy's, even though the Macy's full-line stores are struggling with the middle-income consumers cutting back on spending. If you look at some retailers like Ralph Lauren does cater to higher income consumers than a lot of other apparel brands. For example, PVH, which reported a difficult quarter last quarter, tends to be more middle income. So you can pick and choose and look for ones that maybe are catering to more higher income consumers.
So does that leave the Gap, for example, next week in no man's land?
Gap certainly has been doing better of late. I don't know if I'd say it's in no man's land. Old Navy did have a better quarter last quarter, and it's really coming back from some very difficult results. Yeah. A lot of these companies have internal problems, and they're in different stages of restructuring and turnaround. So I don't know if you can really say that it's just consumer spending that's going to drive their stock prices or their performance. Yeah. So, for Gap, I do think that there are reasons to actually want to own the stock.
Yeah. Okay, David, I'm curious, though, too. I mean, you just said something there kind of about this idea of some of these companies going through these transitions and restructuring. We know Gap has gone through a few iterations. It looks like the current leadership there might have a better handle on things than the previous leadership. But I want to talk about a couple of other companies that are looking to just change their ownership structure overall. Nordstrom potentially going private if the Nordstrom brothers get their way. And then whatever the heck is going on with this Capri Tapestry deal here. Do you think we are going to see that type of consolidation or take private actually work? And if so, do you think we'll see more people follow on?
Yeah, I definitely think so. And Macy's, too, is facing a potential buyout from activist investors. The Nordstrom family has talked about taking Nordstrom private for years. And it really makes a lot of sense because realistically, department stores like Nordstrom and Macy's really just don't have a great market position. And it's very difficult as public companies for them to continue to report strong earnings that investors want. So it makes a lot of sense, actually, for a company like Nordstrom to go private. Now, of course, it does depend on the valuation. I think that Nordstrom is actually quite undervalued. My fair value estimate on it is $40. So it could be that the Nordstrom brothers are kind of taking it private at a low valuation here. And then for Tapestry and Capri, I do think that it will eventually happen. I think that the companies will win their case against the FTC because there have been very few antitrust cases in the apparel and accessory space.
Interesting. Yeah. And it's funny, too. I mean, you bring up the antitrust side of it. We were speaking with Andrew Forman a little bit earlier over at the DOJ on that Live Nation lawsuit. And it gets to the broader question here as to why there would even be a target on the back of any sort of apparel maker right now, given A, how much they're struggling, and B, the fact is, I don't know. I mean, if we lose one of those companies or they get absorbed into another, is that somehow, does choice go down for us?
Well, I think you can make the case that it makes sense because Capri and Tapestry, specifically Coach and Michael Kors, are definitely in head-to-head competition. I think the FTC does want to prevent companies that are in direct competition from merging. I don't think in this case that the FTC will win because the handbag market itself is quite fractured. There are many different brands. However, Coach and Michael Kors definitely have a strong position in the middle market of handbag brands. Also, Kate Spade, which is owned by Tapestry. It is actually going to generate, pretty strong market share when the two companies merge in that middle area of handbags.
Hey, David, really appreciate it. Thank you so much, David Swartz, joining us from Morningstar. We really appreciate your time today. All right, coming up, you got the top three, where we focus in on the top three movers and shakers in the center of the day's biggest stories. That's next. This is The Close on Bloomberg.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
Time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. And first up, James Gorman, the Morgan Stanley CEO, announcing he will be stepping down as chairman of the bank at the end of the year, capping nearly 2-decade run. CEO Ted Pick is eventually expected to take over. I mean, and this wasn't necessarily a surprise, just a timing thing.
Yeah, just a timing thing. And I guess, I mean, look, it's a year-long runway, effectively, that he had to kind of oversee and look over Ted Pick's shoulder. And I'm sure Ted Pick is like, stop looking over my shoulder, and Gorman's moving on. And
Gorman's like, okay, great. This is full confidence in you now. I can kind of walk away and do whatever I'm going to do after this job. All right, we're also watching Elon Musk because who doesn't all the time. He spoke earlier at Viva Tech. Is he stepping down? No, he's stepping to all the things. He was at Viva Tech conference in Paris, where he talked at Viva conference in Paris and warned about the dangers of AI, saying it's dangerous to train it to lie. He also likened it to raising a kid, that like it doesn't know any better. You have to teach it what to do, what not to do, etc. But parents are different.
Well, that's what I was going to say. I remember listening to that analogy, and I was thinking, there are a lot of like rotten kids who grew up to be rotten adults. So I hope that with AI, they find their parenting styles maybe a little bit more effective than in real life.
But did you see that there was like a glitch too when he was on the stage? It's just funny when you have all the techie people and then the techie stuff goes wrong. Enough said on that. And of course, he had a lot of other things to say and a lot of other things that he didn't want to say. But we pay attention to him because he is still, of course, the richest man in the world. Meanwhile, somebody who looked like he was climbing up to be one of the richest people in the world, now a big fall from grace. We're talking about Sam Bankman-Fried. Now, remember, he was in that detention center out here in Brooklyn, New York. We just learned today he was just transferred to a facility in Oklahoma where he'll be for the next 4 to 6 weeks. But the backdrop of all this, that palatial penthouse that he had out in the Bahamas, it's now for sale. You, Alex Steele, can be the owner of that beautiful penthouse for just a cool $30 million, or at least that's the asking price. I think it might be negotiable. Easy, $30 million, no problem. But apparently that won't help him any, right, or something? Because didn't he overpay a lot for that? Didn't he pay at a really high time in the market for it?
Yeah, that's what they're saying. I mean, basically, it's valued at $30 million, but probably not that. And this is and maybe there's some historical value to it because it wasn't like he just lived there. I mean, they were running the whole operation out of here. So I don't know if walls can talk. I don't know.
Is that where you want to buy it?
No,
$30 million.
You know what I would do? I would buy it and I would immediately start, just take a sledgehammer to the wall
and see if
he hid his crypto wallets, behind the baseboards or something.
Although I have to say, have you seen pictures of this thing?
I have.
It's beautiful. That's a circular. I mean, that's nice. I gotta say, it's nice. If I had a cool 30 mil, no problem.
Well, it is a $30 million penthouse in the Bahamas.
Pretty.
Can't go wrong with that.
No, you really can't.
All
anyway.
right. Well, speaking of real estate, we are going to talk a little bit more about that here. Of course, a lot of focus on home sales, not necessarily in the Bahamas, but here in the U.S. We're going to catch up with Danielle Hale when we come back after the break, chief economist over at Realtor.com. We're going to ask her about some of the housing data that we got out earlier this day. That's coming up next, right here on The Close. This is Bloomberg. All right, today the crypto community is well at the edge of their seats, expecting a decision from the U.S. SEC regarding Ether ETFs. The token linked to the Ethereum network has been surging this week ahead of the announcement. Bloomberg Intelligence senior analyst Eric Balchunas joining us right now to talk a little bit more about this. And Eric, is this, I know we don't necessarily know whether this is going to be an approval or denial, but it seems like some of the excitement around this seems somewhat reminiscent of what we saw in the drumbeat to the approval of those Bitcoin ETFs.
Yeah, absolutely. It's just every day is like a roller coaster in crypto. And I'm a tourist, but when I do, hang out here, it is always wild. And so it's par for the course that it's not following normal patterns. We thought we get a decision at 4 p.m. That's typical, normal. Today is the deadline. There is a rumor floating around. We can't confirm it, that it will be delayed by a couple hours. Now, that theory, again, it's a theory, does make some sense because what we've heard is that even the staff was told 11th hour that these were going to be approved. And everybody inside the process thought these were going to be denied until Monday. So that's a real short time to write an approval. You've got to, really put all the research in there you've done. You probably have to have it edited like 10 times. These are lawyers, they're very careful. So it wouldn't shock me if they needed a little extra time. But that said, it could show up on the website in 5 minutes. We don't know, but it's not there yet. And we thought it would be. So we're just refreshing the website for the time being.
Eric, you're the ETF guy. You know the guts of all of this. What would be the holdup? Why would this be so difficult for the SEC?
Simply because it was a 180. It was again, what we're hearing is that everybody, including the SEC, the staff, was preparing for denial, a rejection. But over the last weekend and on Monday, they were all told, okay, we're actually going to approve it. Why? Well, again, everything we're hearing is that the politics changed. There's obviously been a couple things that have happened that, as you can see, where the Democrats just don't want to be seen as anti-crypto. It's becoming an election issue, which is rare for ETFs to be anywhere near an election, but here we are. And so I think the decision was reversed and everybody was caught flat-footed. And now they're, having to scramble both inside the SEC and the exchanges and the issuers.
Yeah, a good point there, Eric, particularly on how this has become a political issue. We were just talking yesterday about, of course, those comments by Trump, basically saying if you like crypto, vote for him. I don't know if that's true or not, but it's certainly indicative here of how it has gotten onto the campaign trail. Eric Balchunas over at Bloomberg Intelligence and the co-host, of course, of our ETF IQ show. We want to continue this conversation about the potential approval or denial of those ETFs, those Ether ETF applications, with Noelle Acheson, author of the Crypto is Macro newsletter, and of course also formerly worked over there at CoinDesk and a few other places. Noelle, as we sort of await to find out exactly how the SEC is going to rule on this, I think Eric touched on something broader, particularly when it comes to this coming up on the campaign trail. The idea that there has been some softening in Washington to this idea of what crypto is, what it can be, and whether it can be complementary to fiat currency rather than competitive.
And the astonishing realization remained that a lot of people do really care about this. Enough Democrats care about this to vote with the Republicans on two very key legislative proposals that we've seen pass through recently. I think it sounds like the higher-ups in the White House are realizing that this could be a very big problem, something that we've been telling them for a long time. They're starting to see it now in the results.
Noelle, let's say that this gets done and we do have the Ether ETF. Does that suck money away from, say, the Bitcoin spot ETFs, or is this going to bring in new institutional investors that haven't had a chance?
That's an excellent question, Alex, something that we've all been wondering. My opinion is that both. That's a very wishy-washy answer, but we have seen already ETH suddenly outperform Bitcoin, where so far this year it's been Bitcoin story. And so that does suggest there is already some rotation. ETH has underperformed. It makes sense. If you want to get that extra performance, then maybe now's the time to switch out of Bitcoin into ETH. However, the main deal of the ETFs is that it does bring in some of the more mainstream investors. Now, I do have to say, we're not going to see what we saw with the Bitcoin ETFs. There's not going to be that huge inflow for the first few months, because the ETH ETF is just not a great product. It is not a good product because anyone who holds it forgoes more or less 4% yield. It's not going to be redistributing staking rewards. And this is a very big deal for investors that care about that. However, not all investors are going to care about that. Many mainstream investors just want the convenience, and they're going to see that 4% loss like a convenience fee. And there are also many institutions who can only hold assets that trade on regulated exchanges, so we could see some demand from them. But that said, it's still not a great product. This is a very big deal for the industry, more than it is for ETH.
I mean, for Ether, though, part of the appeal is that you can stake it, so you can get basically some earning income with it. And that's what makes that product so different from other crypto products out there. Will staking be a part of the ETF, do we know? Or is it gonna, or not, because that made it too complicated to get approval?
It's not part of this round of the ETFs. Maybe one day when the SEC decides whether staking is a security and can be distributed to retail investors, but for now, no. And other ETFs that list on other exchanges and other jurisdictions, staking can be redistributed. But in the US, no, which again makes it not a great product. But you touched on something really interesting, Alex, and that is ETH is very different. It is used in staking, it is used in DeFi. ETH is an asset that was created to be used, whereas Bitcoin, yes, it has its uses, but largely it is seen as a store of value. So an ETF for Bitcoin just makes a lot more intuitive sense.
It certainly does. And it gets to the broader question, are we starting to see, I guess, more of a divergence within the crypto space? The idea that when crypto came about, all the tokens were more or less the same, obviously different sizes, and some were obviously a lot shadier than others. But the general idea was they all kind of had the same function or lack of function, if you will. It was a speculative asset, maybe a store of value. Ether has always been kind of off in its own lane, basically saying, raising its hand, saying, look, you can actually use us. You can buy things with us. You can do things with us. Are we going to see a much broader divergence in that space?
I think so, Romain. I'm so glad you brought that up, because one of the big benefits for the industry as a whole from the ruling, should we see it today, is that there will be broader awareness of ETH. We've seen this already with Bitcoin. One of the big pluses of the ETFs was the marketing machines of the very large issuers and the spread of education as to what Bitcoin is. And when you see Bitcoin, the same frame as BlackRock, that does lend a certain legitimacy. If we start to see the same for ETH, if people start to understand that this is a crypto asset, yes, but it's very different, then they start to understand the advantages of diversification, and that could trigger some demand for the ETFs, or it could also encourage many investors to start to tiptoe into the crypto space directly. That's a whole new mind step that many have been afraid to do. This could encourage them to finally do so. And those of us in industry know that once you do that, there really is no going back.
Noelle, thanks so much. We really appreciate it. Thank you for staying up late for us as well. We're kind of waiting for that news to cross. Noelle Acheson, author of the Crypto is Macro Now. I'll get that. Crypto is Macro Now newsletter. Definitely check that out. To the eco data now. We'll get to that earlier in the day. We got new home sales in the U.S. declining last month. Buyers were deterred by both high prices and, guess what, high mortgage rates. Bloomberg's Michael Sassow is reporting on the story. He joins us now from Atlanta. Michael, what stood out to you? Was it a demand or a supply issue that led to the decline in new home sales?
Well, what's happening, there's been a little bit of turmoil in the market. Numbers have been bouncing around lately, but generally new home sales have been on the upswing. Of course, with interest rates still around 7%, that's going to put a cap on just how high new home sales can go. So you're generally seeing them rise, but rise to sort of a certain level, and they're kind of bouncing around at 600,000, 700,000 a year rate, which is comfortable, which is good for the builders, but not kind of blowout numbers right now.
Where do we stand on inventory levels, Michael? And not just today, but also kind of what's in the pipeline here. Does the inventory situation ever start to work against them?
Well, right now, new home sales inventory is actually pretty high. It's at the highest level in 2008. That's partly a function of existing home inventory is very low. I think there's about 1.2 million existing homes on the market. That's down from 1.9 million a couple years ago. So what's happening is new home builders are actually filling the void, and that's actually good for them. That's giving some opportunity for people generally to buy something. You know, if they can't get an existing home, they can at least get a new home.
All right. Hey, Michael, thanks a lot. We really appreciate that. Michael Sassow from Bloomberg joining us on those new home sales data that we got out earlier during the day. Let's get now to Danielle Hale, chief economist at Realtor.com. Danielle, there's a couple angles for this. For new home sales, how long until rates stabilize will that bring back in demand? Ed Yardeni was talking about sort of higher forever, right? This is a new normal for rates. What's the time lag until buyers are like, all right, I guess I got to just go with it, 7%?
I think every decline that we see in mortgage rates brings some buyers back. There are fairly sizable chunks of buyers that are waiting for mortgage rates to start with a 6 or mortgage rates to start with a 5%, whereas we're up over 7% now. Well, actually, as of today, we crossed under the 7% threshold for Freddie Mac data. So every decline in mortgage rates will bring some buyers back. But I think a lot of existing homeowners are locked into mortgages that are under 6%, that's 90%, and almost 2/3 are locked in at a rate under 4%. So we've got to get much lower before we really get rid of mortgage rate lock as a phenomenon that's holding some sellers back from getting into the housing market.
The result of that was that you saw a lot of new home sale sellers sort of help with concessions, right? Like, we'll do this for you, like, come buy our house. Are we still seeing that, or do the sellers, the new home sellers, actually have more power now?
New homes are still an elevated share of what's on the market for sale. So they're up at about 28%. That's almost twice what we've seen historically normal out of the total number of homes on the market. So shoppers who are in the market are more likely to see a new home for sale today than they are or than they have been in the past. And so that is probably prompting a majority of shoppers to consider new homes, even if they wouldn't have otherwise. And so builders have some room to offer concessions, but don't necessarily have to. Even though month supply of new homes for sale is elevated, we're still seeing that they are able to sell completed homes very quickly. And so one of the reasons that we're seeing that elevated new home sales options for consumers, some of them have not yet been started. And so builders are doing a good job of sort of managing their pipeline to meet the demand, which is lower than historically normal, but still elevated relative to the existing market.
I do want to ask you about the existing market, particularly when it comes to the affordability issue. Obviously, with new homes and the relationship builders have with those homes and the buyers, you can sort of bake in those concessions. Obviously, a little bit harder to figure that out on the existing home sales side. You're basically just dealing with a seller that has to decide where they want to price it and whether they want to budge. Are we seeing them budge at all?
Yeah, we are seeing price reductions back to a level that was normal in the 2017 to 2019 period. So they're not extraordinarily elevated. They're roughly normal, which is interesting given how low supply is in the market. That really is a reflection of low demand and low supply kind of keeping prices in balance, roughly speaking, and sales at a low level. As we see mortgage rates drift lower, we may see demand start to pick up. And we may see that also unlock some selling. And so we may see more activity in the housing market.
How much of a change in mortgage rates do you think we would need to see to really provide sort of a meaningful opening up of this market? I mean, we're still, at least on the average, still around 7%. And a lot of folks out there, at least anecdotally, we know are paying upwards of 8, in some cases 9% on some properties.
Yeah, I mean, I think given that 90% of existing owners are locked in under 6%, I think we're going to need to see rates move back towards that 6% range. We just did a study with the National Association of Realtors, actually, and Realtor.com, looking at where affordability would be if we were to get to that 6% mark. And what we find is that it is going to improve affordability across the board, but at certain price points and in certain markets, we're going to see a bigger improvement in affordability. Interestingly, a lot of markets that are really unaffordable right now do benefit the most from that drop in mortgage rates. So consumers can expect some relief, but the degree of relief they're going to get will depend on where they live.
Right. The degree of relief from like $4.5 million to $4.3 million, maybe a little bit different on that end. When you talk about, say, existing home sales, I'm wondering if those prices have come down enough to finally start matching buyers and sellers, and how wide that gap really is.
So on the existing side of the market right now, we're still seeing home prices climb at the median price point. Some of that is a reflection of more sales being done in higher priced properties. On the listing side of things, which we track at Realtor.com, we see that listing prices have actually been flat. And that's because we're seeing the opposite phenomenon, that even though we're seeing more sales at the high end, we're seeing more listings and inventory sit in the lower price tiers, particularly in the South. So listing prices have actually been flat on a year-over-year basis, even though home sales prices are climbing. What that means for consumers is that you might see more options on the market, but on an actual per home basis, prices are still probably going up. So they're not getting the same relief that they might see in the new home market, for example, where median prices are actually dropping. Again, some of that is smaller construction hitting the market, but we're not seeing a huge run up in prices that we did see over the past couple of years.
Danielle, great stuff. Really appreciate your time today. Danielle Hale, chief economist at Realtor.com. All right, guys, let's get check in on where markets closed for the day. It was not a great day. Let's just put it right out there. You look at the S&P closing down by about 0.7%. You got the NASDAQ 100 closing off by 0.4%, despite the fact that you actually had NVIDIA up for the day after hitting record highs. Boeing, the biggest drag on the S&P, also responsible for 92 points taken away from the Dow. So about a sixth of what we saw in the Dow in terms of selling, and yields moving higher, particularly on the front end after you got that very strong PMI reading earlier in the day on services and manufacturing, and inflation still sticky as well. All of that combining for higher yields. This is the close on Bloomberg. Time now for our Muni Moment. So according to a new study out of Boston University, Massachusetts stands to lose almost $1 billion in annual revenue by 2030 as high taxes and housing costs push wealthy residents to move elsewhere. Joining us now is Mark Williams. He is the primary researcher on the study. Hey, Mark, thanks for joining us. Walk us through the findings, how you did the study, and what you learned.
Sure. Well, the study started really last summer. It was a 9-month slog. We went through a lot of data looking at the U.S. Census data and also the pool of data from the IRS. That allowed us to connect the amount of people that were leaving Massachusetts with how much money they were taking with them. And our conclusion was staggering.
Well, let's talk about that conclusion here, because we talk about sort of that outflow of people here. Where are they going, Mark?
Sure. Well, it was fascinating. The myth would say most people are going south to Florida, but the reality was over half the people that left Massachusetts stayed in New England. So that really begged the question, it's not about weather, so why are they leaving?
So it's more about the money, or I guess the money that would have been taken out of their pockets, so to speak here. Are you finding that the reasons for moving ended up being justified?
Well, it was interesting. We found certain attributes that were very common in the inbound states. For example, the top inbound states, folks leaving Massachusetts, tended to go to Florida, New Hampshire, places like Maine. And the commonality was really 3 attributes. One is 100% of these states had lower income tax, 100% of these states had lower housing costs, and 100% of these states had lower healthcare costs.
So this is Muni Moment, Mark, so this can't be good for Massachusetts. What are some solutions here?
Well, let's talk about the bright spot real quickly, and that is that Massachusetts still scores at the very top in regard to economic health. So from its bond rating and then also from unemployment, it's extremely high. However, there are storm clouds developing, and I think that's where Massachusetts needs to step up and not sit back on its laurels.
So what kind of shortfall is Massachusetts looking at, and how does it manage that? I mean, you can keep raising taxes, right? I mean, you get the tax windfall like you were mentioning, but that's only going to go so far.
Right. So Massachusetts itself last year actually did a millionaire's tax. So they put a 4% tax on anyone making $1 million or above. And what that has done short term is increase the amount of tax revenue. But I beg to challenge this, whether long term this is going to have a positive impact. So fortunately, the U.S. Census data is coming out in September. A lot of academics like myself are going to be parsing through those numbers quickly and sharing that, whether the short-term benefit of higher taxes actually equate to the long-term cost and impact on out-migration.
All right, great stuff, Mark. Really fascinating, the work you did on this, as well as some of the past work. Mark Williams there over at Boston University. I should also point out he's the author of probably one of the best books about the global financial crisis. A lot more coming up here on The Close. We're going to set you up for some of the big market-moving events over the next 24 hours. This is Bloomberg. Wow, what a day today. We came in today, all eyes were on NVIDIA, hoping for a big pop in the market. We didn't get it. That was the big catalyst in the market one way or the other. Here's what we have our eye on over the next 24 hours. It could be potentially market moving, and that starts with that G7 meeting, which continues over there in Italy.
How do we get a seat to that for Italy? That would be nice,
right? I think we have to be a lot more important than where we are
probably.
now.
All right. The real question, I think, is if we're going to see a squeeze out of the frozen Russian assets that they were kind of talking about. We haven't got anything, and that's going to be, I think, the big market mover on that.
All right. A lot of people will be keeping an eye on that. We also get earnings. I thought earnings season was over, but apparently earnings season never stops, Alex. We get a few companies before the bell tomorrow.
Yep, we got Autodesk, we got Deckers, we get Dollar Tree. Dollar Tree's going to be really interesting to see how that lower-end consumer is going.
Yeah, I'm really interested in that as well. And I think Deckers could be interesting, too, particularly coming off of what we heard today from VF Corp. I don't know, Deckers, I mean, they've got all the hot shoes right now, so maybe they'll do a little bit better. I mean, for somebody. I don't wear them, but, you know, other people do. And, of course, if you hadn't been exhausted by all the Fed speak this week, it ain't over. Governor Waller, who I think has already spoken 12 times this week, he's speaking tomorrow at 9:30 a.m. Eastern.
I think total was like 19 this week so far. I'm really into the eco data, though.
Yes, eco data tomorrow, and that includes, we got an update on the University of Michigan consumer sentiment numbers.
This is the final read in May. I love you, Mich. It's one of my favorite indicators. Remember that last time we got it for May, it hit a 6-month low, and the one-year inflation reading hit a 6-month high, and that really did wind up moving the market. But gas prices have come off a little bit since then.
And it gets us, we spoke with a couple of guests about this idea of the disconnect between how strong the economy is and the perception of that strength. I don't know if you saw that great story that we had on the terminal about all the people who think we're in a recession, even though we're not. But anyway, so those sentiment numbers could be interesting. And then, well, you know, it's a holiday season here in the United States. Memorial Day is on Monday, and that means the Treasury markets close early.
Does that mean we get to leave early?
Unfortunately not. Yay. They close at 2 p.m. Our show actually starts at 3 p.m. So I don't know what's happening, but I guess the equity market will still be open, Alex. So don't go anywhere.
And you know, volume's going to be crazy. I'm kidding. It's no one's going to be trading. Everyone's going to put in their positions and go away for the long weekend, not taking on any risk there.
All right. Thanks for joining us today here on The Close. I'll be back tomorrow for all your markets coverage. Balance of Power up next.